Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Grounded Lithium Corp. Please note you can submit questions in the box for the company to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I am very pleased to welcome Greg Phaneuf, SVP Corporate Development and CFO of Grounded Lithium Corp, which trades on the OTCQB venture market under the symbol GRDAF and on the TSXV under the symbol GRD. Welcome, Greg.
Thanks, Matt. Thanks for having us. And thank you to John and the broader OTC team for hosting this event. We do appreciate the opportunity and do like our trading ability south of the border on the OTC. With that, we'll just kick right into it. Greg Phaneuf, SVP Corp Dev and CFO, one of the co-founders of our company. Our company, in a snapshot, is a Canadian-based lithium from brine operation with all of our assets in the province of Saskatchewan. We've been around for 3 to 4 years, a public company for the last 2 or 3, and in our view, a compelling value proposition, which hopefully over the next 20 minutes, I'll put those thoughts forward. I would characterize my slides in 2 main themes, one kind of current events or recent events, and then we'll get into some of the project specifics at the end. So kicking right into it, I will be making some forward-looking information, so I would draw your attention to the disclaimer. And just getting into it. So our vision when, go figure, the CEO's name is Greg as well. We've got 2 Gregs, 2 Dales, and 2 Waynes in this company, so it gets kind of confusing at times. But when Greg and I started the company, our vision was to become a lithium producer. Our experience is rooted in oil and gas, which lithium from brine is a direct pivot and a direct translation from oil and gas into lithium from brine as you're drilling wells, as depicted by this picture on the left bottom of the panel here on the screen. That's our first well that we drilled in the summer of 2022. We've had good results. We'll get into those in a minute. One of the things, though, that we're very excited about is current events. And just before going to there, just a quick snapshot. We are a 6 million Canadian enterprise value company. We have a strong insider support, ownership at 14%, 17% by institutions, and the balance held by retail. As we'll get into, we are cashed up based on a transaction that we announced 2 weeks ago with a large Saskatchewan-based uranium company called Denison Mines. And with that, we'll just turn to that next slide. So one of the things that is important for a small company like ourselves is to have strategic partnerships. And in the sourcing of those opportunities, we came across the folks at Denison Mines led by David Cates. Over the course of the last 3 to 4 months, we put together a transaction which we press released on January 16th. This transaction materially moves our value proposition forward in our mind, in that Denison will provide the capital over the next little while in terms of the project itself. Our project's called the Kindersley Lithium Project, or the KLP for short, but also the transaction with Denison provides Grounded Lithium with working capital over time. A little bit of a structured transaction as depicted in that panel on the top right. Essentially, the transaction or the earn-in agreement with Denison, as they're spending money, they earn a growing working interest in the project. As shown there in the very bottom or the middle of that panel there, Denison working interest at 30, 55, and 75% ultimately. It's a good transaction for both sides. It's a win-win. Denison, being a large uranium company, gets exposure to yet another critical mineral, which is important to their strategy. They're very well capitalized, have been around for decades, very solid company, and very well known in the mining community. The other point I'd also mention in our partnership with Denison is that they bring a lot of expertise. Their technical teams are deploying very much the same sort of techniques that we would do in oil and gas and lithium from brine in terms of in situ extraction. So some of the technical expertise that our team has combined with Denison hopefully will make for a very powerful project moving forward. As I said, this transaction with us provides us funding over the short to medium term. And one of the I guess the criticism, frankly, of our project, if you were to follow our story, was that we're on the verge of a field pilot. And this transaction with Denison gives us the potential of having a funded field pilot, which, in my opinion, should re-rate the stock, which we'll get into in a minute. So what does this mean to shareholders? This slide tries to depict what we believe is our risk NAV or risk NPV. Grounded has had a number of reports filed under our national instrument here in Canada, National Instrument 43101. We came out with our preliminary economic assessment on our KLP, just the first phase of it, which is an 11,000 ton per annum lithium hydroxide monohydrate project. That was independently assessed at $1 billion NPV8 or 1.35 billion Canadian. What we're trying to show here on this slide, everyone, is as we move through the project now with Denison as one of our key strategic partners, we will de-risk that project as we move forward. So it's our assumptions on the chance of success as we move through different phases, the pilot preparation, the feasibility studies, exploitation, drilling, commercial development, and then full-on commercial operations. Let me remind you, we are a 6 million market cap company with a project that has in its first phase $1 billion potential. So in our view, looking at a risk investment or a risk-weighted rate of return, we believe that there's tremendous upside for investors. The bottom panel there just shows how we as a company, having the balance sheet of Denison behind us, we aren't spending the CapEx dollars on the project over the next short to medium term. That's done by our friends at Denison. So from a dilution point of view, as a shareholder of Grounded, we won't have to come out to the markets repeatedly to kind of advance the project because the capital, the funding of it, frankly, is coming from our friends at Denison. So that's a bonus for shareholders. Again, we don't have to suffer that dilution corporately. Another way to look at it is from a pure shareholder perspective. Comps can be dangerous, but looking at some of our more esteemed peers that are in the marketplace, looking at what they've already published as their preliminary economic assessments, this is all public information, compared to their enterprise value, and then doing that same math to what we have in terms of our PEA to our enterprise value, going through the math, taking ultimately our 25% working interest in the project, looking at what we currently trade at, we would argue that there is the potential of a re-rate on our stock. The average is 3.4%. They're depicted on the slide of the enterprise value to the published PEA of some of the companies that we've listed there compared to our 0.4%. So the straight math would imply with a funded pilot, which again was a criticism on our story, now with that taken care of, arguably with the investment from Denison, I would say that the re-rate potential in our stock is certainly valid. Just a soundbite on the PEA itself. This is published. You can see it on our website. It's also on CDAR, the public filing for materials here for Canadian listed companies. As I mentioned, $1 billion NPV8, an IRR after tax of 49%. This is using $25,000 per ton of lithium hydroxide monohydrate, which if you're following the lithium space, we all know that the price is south of that. And there's no slides here talking about the macro dynamics. We can certainly have discussions in the Q&A if we want about it. But this is based off 25,000. Still, with those numbers, we have top decile, top of the leaderboard economics when it comes to a lithium from brine project in Western Canada. One of the things that drives those economics, and we'll get into it here in a slide or two, is the fact that we chose to position our company in the basin where we believe has the best operating and capital cost parameters. In a commodity business, given our experience in oil and gas, low-cost operators, whether on the CapEx or on the OpEx, typically win and get the marginal investment dollar. So in our experience, we consciously decided to go to a place in the basin where we think those parameters exist. And hence, the capital intensity here in the middle of the page of 30,000 and change on a per ton basis is one of the lowest lithium from brine operations in the space. This is right out of the PEA. This isn't from our model, right out of the PEA. Just draw your attention to the middle there, looking at the cash flow coming on or coming off the project after tax. Again, 25,000 US dollars per ton at 11,000 tons per year. This generates on a 100% basis a $200 million cash flow. with our project now being shared with Denison, our 25% would be 50 million of that. So again, still very compelling economics for a small company like ourselves having a pretty significant share in a multi-billion-dollar project. With some debt financing, again, it gets down the road, but with debt financing, this project can pay back within 2 years at 25,000 US per ton. Just turning the page to now some of the project specifics. This is more of an animated slide, so you don't get the benefit of the animation, but in oil and gas, there's certain rules or playbooks that companies would look to develop assets, and that can be used right across the page to a lithium from brine operation. It all starts and ends with the rock. If you don't have the right rock, you won't have the resource, you won't have a commercial project. So Greg and the rest of our technical team, when we were looking at beginning the company and founding the company, it was where is the best place, as I said before, to develop a lithium from brine operation. So the rock and resource quality is super important. Part of that goes in there with also minimizing the capital and operating costs. Low-cost operators win. If you follow the lithium from brine space, technology is certainly a key aspect. We are very proficient when it comes to subsurface extraction and water handling, given our oil and gas background. We aren't scientists, and we know where we're good at and where we're not. So what we've chosen to do with our company is look for the best technology that exists out there on extraction technology. In a later slide, you'll see the name Koch. We've partnered with Koch Technology Solutions. They've since been changed their name through an acquisition of their operation by a U.S. private equity firm, but the root technology is still the same. Koch's very well known in the brine circles. They are a significant investor in Standard Lithium, and others in our space are also exploring technology solutions with Koch. So we think we're in really good hands when it comes to the extraction technology. Jurisdiction plays a key role. Saskatchewan is a great place to do business. Saskatchewan's pro-business, pro-resource oriented. You know, they have uranium, they got gold, they've got potash, they got oil and gas. And we would also be very excited to see that the Saskatchewan province also has lithium, which we want to be a key player in it. So jurisdiction plays a role in terms of permitting, regulatory access, low tax regime, etc. And the last, all those things are important, but you have to have a team that has the experience and the history of success, which our team and board have. So just to give you a bit of, a glimpse as to where we are in the Dupereau or Leduc sequence over the provinces of Alberta and Saskatchewan. We are on the Saskatchewan side. Our operation is that orange dot you see there on the screen. The Dupereau and the Leduc are very prolific areas for typically oil and gas or resource development. So we've chosen to go in that area. One of the key attributes, though, of where we are in our part of the province is that, I don't have a pointer, but that pink-purple belt is the Dupereau-Leduc over the course of Alberta into southeast Saskatchewan. So where we are, we're on that bulge area, as you can see on the screen, and that has all kinds of benefits. One, we're shallower, frankly. So if you're drilling for your resource, depth means money. It's extra time, it's extra cost. It goes to my point earlier about capital intensity. Our drilling would not have as many meters to drill as some of our peers would, either in Alberta or in southeast Saskatchewan. The other interesting thing here, and I'm a finance guy, not a geologist, enough to be dangerous, is that over time, the hydrocarbons migrated from this area. And while hydrocarbons are important for oil and gas, for a lithium operation, hydrocarbons are a contaminant. So you don't want to have contaminants in your brine. You have to spend money to filter those out before putting them through an extraction facility. Can be done, but it's just extra capital. So again, to the point of picking an area where there's low OPEX and low CAPEX, we believe where we are near Kindersley, Saskatchewan, is some of the best rock in the basin. And we have a dominant position in this area, as depicted by this slide. This is our current land position. There are some sections outside this land map, but this is the area that Denison has made its strategic investment into grounded with. So that's denoted by the pink outline. That's the KLP proper. The red polygon is just the first phase of the KLP. And that red polygon, if you remember the slide on the PEA, that PEA only covers that red polygon. So that's $1 billion NPV project in that red polygon. And if we replicate that over the course of the existing land base, there's 3 maybe to 5 phases of 11,000 tons per year of lithium hydroxide monohydrate on our existing land base. You'll note that there are lands that are contiguous as well as checkerboard. The checkerboard is not an issue. If you drill down into this map, you can see the little white teardrops, which denoted into the well or by the wells. Those are all on mile spacing. So we're actually developing our existing land base on already a checkerboard basis, a mile by a mile is each of those yellow blocks. So having a checkerboard land position is not an operational issue at all. Over time, we'll continue to fill in that map sheet, but that does not present challenges to us at present. This has a 4.2 million tons of inferred lithium carbonate equivalent value, or 4.7 million tons of LHM. Of that 4.7, a million of it has now been reclassified into measured and indicated, a higher confidence level as we move forward to move the project. So a very large land base, more than sufficient tonnage to have one or more operations off of our project. This might be a little bit more complicated, but it gets into some of the aspects of why we chose where we are. It's one thing to have grade, and I should have mentioned our grades mid-70s to low 80s, no different than some of our peers elsewhere in the basin. But grade's one thing. If you do not have deliverability of the wells, so lots of brine, lots of water coming at you, the math of simply grade times volume won't work out to a commercial project. So again, all of our homework of picking where we are was done for a conscious reason. The wells, in our view, and as evidenced by our well that we drilled in the summer of 2022, shows that these wells will deliver sufficient volumes of brine that, combined with the grade that we've already tested, will give us a very commercial project. We only have to drill 24 wells, 2 wells of which would be kind of held as your swing as you're taking wells down to replace pumps and such. So 24 wells would drive ultimately 11,000 ton per year project. So as this chart tries to show, if you have lower, deliverability going to the left of the axis, your CapEx rises, you have to drill more wells to get the same commercial production. We're on the far end of this map, or this chart, where we would deliver between 18 to 20,000 barrels per day per well. And that, again, gives you an economic project. It's a key thing that we looked at when choosing our land base. I mentioned Saskatchewan. I am a Sasky boy myself, but it wasn't that Saskatchewan was chosen by us. Saskatchewan chose us in terms of the best place to find the best rock to have a commercial operation. Saskatchewan's ranked third by the Fraser Institute in terms of regimes, only displaced by Nevada and Western Australia. So a great place to do business, as I mentioned earlier. We're close to rail, we're close to roads, we're close to power, we're close to natural gas, which one of the questions oftentimes comes is power requirements for running the pumps on wells, but we have an abundance of power nearby and ample gas if you want to run our own cogen. ESG, I think, is a good soundbite. There's lots written about lithium from brine versus some of the spodumene or other extraction techniques to get lithium. A lithium from brine operation has 1/3 the carbon footprint of a spodumene operation. The benefit also too is you don't have the nasty open pit mines as depicted by the pictures, or the big large salars in Latin America. So this is very much an ESG friendly story. Our operation would be very much what you see in that bottom picture, which is a standard lithium facility in Arkansas. We would have very much the same sort of buildings on a full scale operation. So ESG, we do check the box, which is very important. I'm coming up on my time before the Q&A, so just a couple sound bites on the DLE. I'm sure there's all kinds of information out that you can read on different extraction techniques. We've chosen to go down the DLE path. As I mentioned earlier, our partnership with Koch is something that intrigues us. They're world leaders when it comes to extraction technology. The picture in the middle is what you would see in terms of a right-sized field pilot that we would move to the facility in Kindersley. We've all got this embedded in terms of all of our costing. You can see there on the right what we provide versus what they provide. It's not that difficult to put in place, and we're looking to do that in conjunction with our friends at Denison as we think about next steps for the project. And on that note, I'm just going to skip a couple slides. This is somewhat dated, but I wanted to kind of illustrate what the steps are in terms of getting to a commercial project. This again needs to be worked out with our new friends at Denison. We'll have some views there, some presentations, some analysis as to how this presents itself and how it moves forward. But really, the steps are the steps. The orange, we've already done it, and we've actually already finished that next wedge there, the preliminary economic assessment. So now we're moving quickly as we can to a field pilot, do some additional drilling, some additional lab work to move to a pre-feasibility study, which then gives you some impetus and some credibility when it comes to putting together a larger feasibility study, which moves into offtake agreements, project financing, and then have the fun part of building the project. This shows 2026 as first production. That probably is now dated, like I said, but illustratively, here's the steps that we would go through as a group with Denison to ultimately get to our first phase, 11,000 tons per year. We're on track, and the message I would say with this is that everything that we've done to this point, that we said to the market, we have done. We've drilled wells, we've proven out the resource, we've got a great partner in Denison, and looking forward to move the project forward. So that's it in a nutshell, why invest in Grounded. The Denison transaction de-risks us on a number of fronts, as well as the project itself. We have the potential of a funded field pilot, which I think takes the monkey off our back in terms of how the market was valuing Grounded. We have a world-class asset with world-leading economics when it comes to MPVs and IRRs. We have a great team. We're proven in oil and gas. And again, it's a layup when it comes to lithium from brine. And then macro-wise, I say the last point is, with the price of lithium the way it's turned out in the last 6 months, the demand for lithium is not going away in our view. The macro dynamics still shows very strong demand. And I think if you wanted to play the commodity on an inexpensive way to do it, I think GRD or GRDAF is a great bet. That's it. I'm going to now turn it over to questions. And let me see. Looking at the polling here. The first question here that I can see is, what is the infrastructure in place for your project? The short answer to that is that we've aligned ourselves with a number of companies that helped us drill the first well. We have vendors in the queue that would help us in terms of the extraction technology, as well as all the polishing and refining that goes on with it. We have those vendors in place. Nothing's been engaged. We have preferred vendors in that regard that we believe can build the project I didn't mention it in the slides, but the price tag on that first phase project is 450 million Canadian, of which half of that would be likely project finance. So we do have vendors in place. The infrastructure has not been built yet at the field pilot. Question here, how much influence will Grounded have in the project now with Denison having a majority working interest? That's a good question. We're very excited to work with the Denison folks. The way that the agreement works with them, we're under a management contract for the first couple of years to manage the day-to-day operations. Certainly they're the operator, as agreed to in the agreement, but we get to deploy some of our expertise to them and very much look forward to sharing, as I mentioned earlier, the technical knowledge that they bring from their in situ uranium operations to an in situ lithium from brine operation. We look forward to providing input. We definitely have some experience and expertise, as do they. And I think the combination of those two companies results in the highest chance of success possible for a project. Question here, can you speak to the management team and expertise behind your project? So didn't get into it. Pretty humble folks here. Don't like bragging about what we've done. But let's start with Greg Smith. So Greg Smith's our CEO. He was the COO of Petrobank, Petrobakken. That had a long history. When Greg was there, he grew production on a barrel per day basis from 2,000 to 50,000 barrels per day. It was sold. So he's had a history of building companies. He's done that repeatedly in his career. I've had some successes along the way as well. I was involved in Western Oil Sands, which is a large oil sands company. That was ultimately sold for $7 billion. Been in the junior startup game a few times. Some of those have done well. Some of those have been a push, but that's the nature of a junior company. So we do have a history of success. And then moreover, our board, very well accomplished across disciplines. John Wright is our chairman. He's the ex-CEO of Petrobank, Petrobakken. Mark McMurray, geologist by training, but longstanding investment banker. And Dave Antony, a chartered accountant by profession, but a very knowledgeable person when it comes to the junior capital markets. That's our board, along with myself and Greg. We also have advisors alongside of us, whether it be on the geology side, the technology side, or logistics, that give us advice along the way. So we believe we're in good hands when it comes to the management team and expertise to build this project. Question here: are you planning to do any outreach or promotional activities in the U.S. like the North American Battery Show in Detroit? I actually was in Detroit a couple of years ago, I think, for one of those shows. We do try to keep our story fresh in investors' eyes. Awareness is something that we consider. I think with the lithium prices the way that they are, and maybe lack of a love or joy for lithium companies in the marketplace, spending money on awareness is always a balancing act. We do intend to communicate the story, but we have not signed up to that specific show. Question here: can you compare project dilution versus corporate dilution with respect to shareholders? Great question. So I guess in a resource company, you always want to think about how you move a project forward. And as a company, you have dilution either at the asset level or the corporate level. And as I mentioned at the beginning of the presentation, this transaction with Denison does dilute us at the asset level, no question. But we maintain our corporate ownership that we have currently. And as Denison is spending money, incurring project expenditures, that's not coming on the backs of Grounded. So we don't have to access necessarily the capital markets. So as the value of the project increases, we don't suffer the corporate dilution as opposed to the asset dilution. One of the points that I like to mention, and it comes back to some of my experiences in the resource business, Western Oil Sands, if you knew the story, was a 20% working interest owner in a large oil sands project, and that sold for $7 billion. Now, I'm not drawing a parallel from Grounded to Western, but my point is having a non-op passive interest can be just as rewarding to shareholders than having a majority stake. And that's the opportunity that I think that Denison with Grounded presents itself in having an investment or a share in Grounded. Another question here, and thank you for the questions, everyone. What is the break-even price for your project? Much has been written lately too as well in terms of how the current lithium price has affected projects. Again, we're not open pit, we're not spodumene, we're lithium from brine. Arguably, the cost structure for some of those projects, together with the price they receive for their project, does present challenges with the current lithium price. The beauty of a lithium from brine operation, again, if you're in a low-cost environment, is that you can withstand lower prices. We have resilience to the downside and nothing but upside if the price recovers. Running our corporate model, we're probably between 7,000 to 8,000 US per ton as our break-even price. When Greg Smith and I started this company, we were modeling 9,000. That was the current lithium price at the time. We were modeling 9,000 US per ton and still getting respectable economics. So at 15,000, you can draw a conclusion that we still have a very economic project, less than what the PEA suggests, but we still have a very economic and robust project at current prices. Just last question here I see. I'm getting close on time. I got 15 seconds left. Can you provide a link to your resource assessments? Certainly, it's on our website, www.groundedlithium.com. And you also can access those through the CDAR Plus website here in Canada, which is www.cdarplus.ca. With that, I'm at exactly 30 minutes. If there's no further questions, I do thank everyone for their time and attention this morning. There's plenty of information on our website. If you have questions, please, I think, go through OTC. We can answer any questions I didn't get to today with responses through that way. So again, thank you for your time and enjoy the rest of your day.